Good afternoon. This is Tom Alexander. It is Sunday, April 27th. This is the weekend update for the week beginning Monday, April 28th, 2025. And we had a ripping rally last week, and all of a sudden it seems to be all systems go. We have all sorts of bullish technical signals. I saw something on X today about a super Zweig breadth thrust. We have people on CNBC talking about the possibility of a new bull market or the bull trend continuing. And this is quite a change from a couple of weeks ago when the world was ending. Welcome to trading and welcome to news about trading. And this is lesson number 1,785,012 of why you have to be your own analyst. I am an auction market trader. I follow price action. I analyze markets and price action through the lens of how auction markets develop. And I hope you do too. That is my overarching message in these videos, is to display the incredible power of just looking at price action through the lens of auction market concepts. So let's take a look at the markets and talk about the possibilities here. We could have resumed the bull trend or beginning a bull trend. That gets down to semantics. But we also could still be in a bear market. So let's take a look and see what price action tells us about both possibilities. Okay. Here's my screen. This is the SPX, and I'm going to go through each of the primary U.S. trading indices this afternoon. You can see on my chart here, there are a couple of things I want to point out. First of all, if you're, I don't know of a simpler way to identify a trend than to see if that market in that time frame is making higher highs and higher lows or lower lows and lower highs. And we were in the process of making lower lows and lower highs until late last week when we took out the pivot high of April 9th. And we've done that now in most of the indices. I think the Dow is the laggard at the moment. But if we're in a bull market, the Dow is going to catch up. But I digress. So at the moment, we appear to have continuously restored a bull trend. Now there's work to do here. We're still well below 200-day moving average. It's rolling over, et cetera, et cetera. We are also, I'll point out, in an elevator shaft, meaning we're in a giant gap that extends all the way up to 5670. So there's work to do here. I also will point out we are up 14.44% off the print low into Friday's close. The decline lasted 21.35%, and the current rally has occurred in only 13 bars. Now, even if we're in a new bull market, this rate of change is not going to continue unless, of course, China is announced as and annexed as the 51st state, in which case it's possible this rate of change could continue. But barring something like that, it's unlikely that this rate of change will continue. We are only 11% and change from a new all-time high. That's not that much. That's less than the ramp we've had to date. So here are the levels. And by the way, if you want to see these levels, and you want to print the levels out, go to my website, alexandertrading.com, click on, this is free, click on weekly update, click on weekend report, and you can get a PDF that has all these charts in it. You can also go back and you can watch the videos for at least the past couple of years, and also their PDFs and reports, so you can print the charts out if you choose to do so. Also, if you find value in this, please like and subscribe. Okay. Now, I mentioned that the simple way to identify a trend, and one that is objective and consistent and works most of the time, is to identify whether a market is making higher highs and higher lows. That is one way of showing a migration of value. Now, let me show you an instance. I always like to show you something that works, but then I want to show you why it doesn't always work. And you cannot just rote take, unfortunately, anything in trading and rote apply it. So let's go to the 2000 bear market. And there are a number of lessons inherent in looking at the 2000 bear market. Everybody, we all traders have very short memories. All traders are always fighting the last war. Everybody is sitting around waiting for the top of 2020 to occur so they can sell top tick and then buy at the bottom tick, because we all know that's exactly what we'll do, right? We won't get shaken out on rallies. No, that would never happen. We're going to sell here and we're going to buy here, guaranteed, right? Well, probably not. And this is why trading is difficult. It's difficult even when you know what the trend is. It's certainly difficult when you don't know what the trend is. Now, this is the 2000 bear market. It began in the SPX, and I'm not going to go back and show the different indices, but this was another confounder because you had different indices making different highs at different times, which was a confounder. But you look at the incredible retracements that you've had. You had the drop here, then you had a rally that retraced like 95% of the decline. You had lower lows and lower highs, and you had higher highs and higher lows. Then it started again. You had deep retracements all the way down. And this is typical, and this is what we could be having now. I mean, these are ripping. Here's a 20% retracement in a bear market. This is typical of bear markets. Now, this is a commonality. This is something that I cannot find an exception to. Bear markets have ferocious rallies, far more ferocious rallies than do bull markets. Bull markets typically grind and grind and grind and grind. You can go months and not have a 2% retracement, and every day is a 0.5% higher, 0.5% higher, 0.5% higher, 0.5% decline, 1% higher, 0.5% decline, etc. So bear markets, in my opinion, are easier and more fun to trade. Now, I use easier in the context of a relative term. Trading is never easy. We all know that, right? Okay, so back to the present. Let me do this the quick way. So here we are. So are we in a new bull market? I don't know. These are the immediate important levels. And to the upside, we're in a giant, again, gap here, an elevator shaft that extends up to 56, 70, 71. The critical area to the downside is down here. This is that gap from last week, 52.91, 53.57 right here, back to the downside. Okay, let's take a look at the other indices now. Now let's look at the NDX, and we've had not quite an 18% rally in the NDX in 13 trade days. The decline in the NDX was a little bit deeper than that of the SPX, down 25.5%. And how far are we from new all-time highs? Let's look. I'm surprised I didn't put this in here, but we're 14.38% from all-time highs. Okay, let's take a look at the Russell. And the levels that I have highlighted here are your important critical levels. I don't derive these levels from magic numerological concepts of Fibonacci, Gann, and all the stuff, floor pivots. I can go through a whole list of things that don't work in a random. From an auction market perspective, the only levels that are of objective, consistent interest to you are levels created from the actual actions of buyers and sellers. And so all of these levels are just that. So these are the levels that you want to be keeping an eye on. Now, the Russell, you can see, is 26% from a new all-time high. That's a long way, which sets up a number of different scenarios. If we were to go to new all-time highs in one or more of the indices, it's very unlikely the Russell would confirm that. But we'll worry about that if we get there. All right, there's the Russell. The Dow is lagging a little bit, as I said. It's still below this triple top, the first leg of which reached its high on April 9th. It's 12% from a new all-time high. Then if we go to equal weight S&P, here are the levels there. And then New York Composite, which is a very broad index. And look, it's less than 7.5% from a new all-time high. This is every stock listed on the New York Stock Exchange. This is the broadest index. So this is rather interesting. I haven't seen this talked about a whole lot. So those are your levels. That is where we are from an auction market structure perspective. All of the indices now, with the exception of the Dow, have broken above that April 9th high and are making a series of higher highs and higher lows. Let's take a look at the internals, the technicals. Okay, I landed on VIX, so we'll talk about VIX. VIX is still relatively elevated. It is above 20. It's just shy of 25, but it's dropping, and it's dropping rather dramatically. So if we are in a new bull trend, you will see VIX below 20 probably in short order. There's a long way for VIX to go to get down to levels that we saw at the end of last year, down somewhere in the mid-teens. So it'll be interesting if we see that. I won't speculate. Let's just watch and see what happens with VIX. But it is bullish that VIX is dropping. Okay, internals. This is really interesting now. I've been talking about the NYSE data and what you see here, the 10-day, this is the red line is the 10-day moving average of NYSE advancing issues 5. The green is 5-day, and below is a histogram of breadth. Breadth has closed positive now 4 consecutive days. And by the way, we have 4 consecutive days of higher closes in the indices. That's interesting, and it's starting to push the envelope. Even if we're in a new bull trend, I'm going to be rather surprised if we just blow through 56.72 without some sort of retracement. But we'll see. I want to make note now. Next week is a real test, because if we are in a bear market, there is very little room, time or price wise or structurally, for this market to continue to rally. If it does, then we're almost certainly in a new bull trend. However, this is at a level from where, if you are in a bear market, this market is close to turning. Now I'm going to show you again why you have to be careful. Here is a similar level that we've reached now in the 10-day moving average of NYSE advancing issues. Occurred right here. And we got a pause here. The market went sideways, but it went a lot higher before we got any sort of significant retracement. And you got a minor retracement after it went another 5% higher. So these are things that we will be looking for next week that will help us to determine how close we are to a top and the significance of that top. And really, it boils down to price action. If we get a retracement next week, this level is critical in all the indices, this gap that occurred last week. So this gap should hold. And if we trade into this gap, we should get a move away from it very, very quickly, if indeed it does trade into this gap. You guys have a wonderful week, and I'll speak with you again soon.